Okay, if you're watching the price action in New York right now, it probably feels like a moment of triumph. Silver is trading just above $70, green candles are stacking, and commentators are calling it a historic breakout. From that angle, it looks like you're standing at the frontier of the market, witnessing something new being born in real time. But that perception is wrong. What you're actually seeing is not the future of silver pricing, it is the past catching up. New York is not leading this move, it is reacting to it. To understand where silver is truly headed, you have to stop watching New York altogether and shift your focus east. While Western traders celebrate a price near 70, physical silver on the Shanghai Gold Exchange is already changing hands at a level that converts to roughly $75 per ounce. That difference, nearly $5, is not a curiosity or a temporary imbalance. It is the most important signal in the global metals market today. A $5 gap between two major pricing centers means we are no longer dealing with a single unified market. We are living in a bifurcated system. In the West, banks and paper exchanges are still fighting to keep silver anchored around 70. In the East, the industrial economy has already accepted that 75 is the clearing price. This gap behaves like gravity. It pulls metal away from the lower priced market and drags it toward the higher priced one. Until those two prices converge, the Western system will continue to lose physical inventory. This is the central misunderstanding most investors still have. The spot price displayed on a phone screen is no longer a real-time measure of value. It is a delayed signal, a reflection of where price has been, not where it must go. The move above $70 is not the end of a squeeze. It is the paper market attempting to close the distance between itself and a physical reality that has already moved on. In theory, this should not be possible for long. In a perfectly efficient global market, an ounce of silver should trade at roughly the same price in New York, London, and Shanghai. When a discrepancy appears, arbitrageurs step in. They buy in the cheaper market, sell in the more expensive one, and pocket the difference. That activity is supposed to force prices back into alignment. Buying pressure raises the lower price. Selling pressure caps the higher price. Balance is restored. That mechanism is breaking. Instead of narrowing, the gap between New York and Shanghai is widening. The reason is simple and brutal. Demand in China is so aggressive that even with metal flowing in, prices there continue to rise. Arbitrage traders cannot move physical silver fast enough to satisfy the appetite. This tells us something critical. The shortage is not happening on paper. It is happening in the real world. Futures contracts do not power factories. Physical metal does. For decades, investors believed New York set the price of silver because it traded the most volume. That belief was only partially true. New York trades enormous volume, but it is almost entirely paper. Futures, options, swaps, and derivatives dominate the flow. Shanghai trades something very different. It trades bars, delivery, and physical settlement. In times of surplus, paper markets can dominate pricing. In times of deficit, physical markets always take control. We are no longer in a surplus environment. That makes Shanghai the price leader. Once you internalize that shift, the $70 price in New York looks completely different. It stops looking like fair value and starts looking like a discount. It is the bid of a stressed system trying to keep inventory from disappearing. The Western exchanges are offering silver cheaper than the rest of the world, and whenever that happens, supply vanishes. Sophisticated buyers understand this. They are using Western exchanges as a source of discounted metal. They stand for delivery in New York around 70, take possession of the bars, and immediately revalue them to the global price closer to 75. The Western system is effectively subsidizing the rest of the world by selling silver below its true clearing price. That subsidy is not infinite. Every week, reported inventories at Western vaults continue to decline. The reason is not mysterious. The flow of metal always follows the highest bid. A miner in Mexico has little incentive to sell into a system paying 70 when buyers in Asia are willing to pay 74 or 75. New supply is bypassing Western exchanges entirely. What remains available for delivery is legacy inventory, metal accumulated years or decades ago and stored in vaults. That stockpile is finite. When it is exhausted, the exchange faces an unavoidable choice. Raise prices to attract new metal or fail to deliver. This is why the price finally pushed through 70. It was not driven by a chart pattern or a sudden shift in sentiment. It was driven by necessity. The bid had to rise to slow the outflow of physical silver. But the problem for Western markets is that every time they raise the bid, Shanghai raises it again. It becomes a chase, and the West is not winning. None of this implies a straight line upward. Arbitrage is messy. It involves shipping delays, regulatory frictions, and capital controls. There will be volatility. There will be days when the paper prices smash lower in an attempt to trigger stops and regain control. But the underlying magnet remains. As long as silver trades significantly higher in China, every dip in New York simply increases the profit incentive to buy there. A drop to 68, while Shanghai holds at 75, does not weaken the bull case. It strengthens it. This is why the Shanghai price acts like a buoy. It makes it extremely difficult to crash the market and keep it down. The mechanics have flipped. Suppression accelerates up. The drain. Stability now requires higher prices. That brings us to the most important question of all. If silver is trading at a premium in China, who is actually paying that price? Is it speculative capital chasing momentum? Is it government stockpiling? Or is it something far more structural and far more dangerous for the Western system? The answer lies not in trading desks or hedge funds, but inside factories, warehouses, and supply chains. To understand why China is willing to pay any price necessary, you have to understand what happens when silver disappears from an industrial economy. And that is where the story continues. Once you move past the misconception that silver's price is being set in New York, the entire picture changes. The $5 premium in Shanghai is not an anomaly. It is a symptom. It is the visible fracture line of a system that no longer functions as a single market. The reason that gap refuses to close is not speculation, manipulation, or temporary dislocation. It is demand that cannot be deferred. China is not paying $75 for silver because it wants to. It is paying that price because it has to. The country sits at the center of the global manufacturing machine, and the managers running that machine have reached a conclusion that terrifies them. Without silver, production halts. And when production halts, everything else collapses with it. For decades, global manufacturing was governed by a single principle: efficiency. Inventory was treated as dead capital. Warehouses were minimized. Materials arrived at the factory floor hours before they were needed, not weeks or months. This philosophy, known as just-in-time, made companies lean, profitable, and competitive. But it only worked in a world where supply chains were perfectly reliable. That world no longer exists. Chinese manufacturers learned this lesson the hard way during the pandemic. They learned it again during the semiconductor shortages that brought entire industries to a standstill. And now they are applying that lesson to silver. The shift is subtle, but its consequences are enormous. They are abandoning just-in-time and embracing just-in-case. Instead of purchasing silver for next week's production run, they are securing supply for next year. Instead of trusting global markets to deliver metal on demand, they are building internal reserves. A solar manufacturer that consumes 1 million ounces per month is no longer comfortable holding a few days of inventory. It wants months. Battery producers are doing the same. Electronics firms are doing the same. The logic is brutal and simple. Paying $75 today is cheaper than paying $100 tomorrow, and far cheaper than shutting down an assembly line. The cost of silver itself is not what scares these companies. The cost of interruption does. If a factory runs out of silver paste, production stops instantly. Workers go home, contracts are breached, customers cancel, orders. The financial damage from a shutdown dwarfs any premium paid for raw material. That extra $5 per ounce is not seen as an expense. It is seen as insurance. This mindset creates a bottomless bid. As long as factories are operating, demand does not respond to charts, technical indicators, or speculative sentiment. It responds only to availability. If silver is offered, it is purchased. If it is scarce, the bid rises. This is not speculation, it is industrial survival. The next question is obvious. Where is all of this metal going? Public inventory reports from the Shanghai Gold Exchange show increases, but nothing that appears explosive. To a Western analyst, the data looks manageable. That conclusion is dangerously wrong. China operates massive free trade zones in places like Shanghai, Shenzhen, and Hong Kong. These bonded areas allow goods to enter without formally entering the domestic economy. Metal can sit there indefinitely, untaxed, unreported, and invisible to most global tracking systems. Shipments of silver are flowing into these zones from London, Switzerland, and other refining hubs. Once metal enters these warehouses, it effectively disappears from the visible market. It is not reported on Western exchanges. It does not show up in standard Chinese inventory statistics. It becomes dark supply sitting in limbo, waiting for solar installations to ramp, waiting for battery factories to expand, waiting for geopolitical shocks, waiting for the next supply disruption. Once silver enters the system, it does not come back to relieve shortages. It is removed from circulation. This creates a profound illusion. Western analysts look at published data and conclude that China does not hold that much silver. They are looking at the storefront, not the warehouse behind it. Estimates from logistics flows and customs data suggest that hundreds of millions of ounces are being absorbed into these bonded zones. It is a black hole that swallows supply and never releases it. The timing of this accumulation could not be worse for the global market. It is late December. Chinese solar manufacturers are racing to meet year-end installation targets. Demand for advanced solar technologies is surging. The amount of silver required for these systems is enormous. In fact, Current consumption by China's solar sector alone is approaching, and in some estimates exceeding, total annual global mine production. That statement cannot be overstated. One industry in one country is consuming the equivalent of what the entire planet extracts from the ground each year. This is why the Shanghai price continues to climb. Companies are bidding against each other for the same limited supply. One offers 72, another counters at 73, a third jumps straight to 75 just to secure delivery. This is not speculative frenzy, it is industrial desperation. Compounding the issue, China restricts the export of its own silver resources. Ore and concentrate remain domestic. Miners are funneled into the local system. Even that is not enough. Imports must fill the gap. Bars are pulled from London, bars are pulled from New York. The global market is being drained to feed one industrial engine. Now shift your focus back to the United States. American manufacturers also depend on silver. Technology firms, automotive companies, defense contractors, and energy producers all require steady access to the metal. But they are competing in a global market against a buyer that is willing to pay more and stockpile longer. When a Swiss refinery has a limited number of bars available and Asia bids 75 while New York bids 70, the destination is obvious. The metal goes east. This leaves U.S. companies exposed. They call suppliers and hear the same response. Allocations are delayed. Delivery times are extending. Premiums are rising. The price quoted on a screen no longer reflects the price required to secure actual metal. This is how inflation enters the domestic economy, not solely through monetary expansion, but through physical goods leaving the country in search of higher prices elsewhere. Strategic materials are exported. Higher costs are imported. Cash balances do not solve this problem. You cannot print silver. If silver is sitting in a bonded warehouse in Shanghai, it is not going into a factory in California. This creates a structural vulnerability. Supply chains that once felt global and flexible are hardening into regional blocks. And at this moment, the Asian bloc controls the metal. The consequence is unavoidable. The gap between New York and Shanghai widens. Physical metal flows east. Western exchanges face a dilemma with no clean exit. If they suppress the paper price, they accelerate the physical drain. If they raise the price, they expose short positions and lose control of derivatives. Either path results in loss. This is why price behavior has changed. Smashes no longer hold. Dips are shallow. Every attempt to push silver lower is met with immediate buying. This is not sentiment, it is structure. Beneath all of this lies a deeper force that most traders still refuse to confront. Currency. Silver is rising even as the dollar remains relatively strong because silver is not responding to short-term currency fluctuations. It is responding to a shift in the global monetary order. China is moving toward a system anchored in resources. The dollar remains anchored in debt. When silver trades at a persistent premium in Shanghai, it is not merely an industrial signal, it is a monetary signal. It reflects a preference for physical value over financial claims. It is capital choosing possession over promise. Paper shorts in New York cannot overpower a physical bid funded by sovereign currency. This is no longer a simple trade war. It is evolving into a currency war, and silver has become one of its most visible scorecards. Understanding this reframes the entire move. What looks like volatility is actually migration. Capital is relocating toward durability. Markets are repricing risk not in basis points, but in ounces. And that brings us to the final layer of this story. If the physical market is in control, if currency dynamics are shifting, and if arbitrage is pulling price higher, what happens when these forces fully converge? That answer belongs to the final part of this analysis. Once you accept that silver is no longer being priced by a unified global market, the final pieces fall into place. The arbitrage gap between New York and Shanghai is not just a trading opportunity, it is evidence of a deeper transformation. What we are witnessing is not merely a supply chain imbalance or an industrial squeeze. It is a shift in how value itself is being measured. For the past half century, the United States dollar has functioned as the world's reserve currency. That status granted an extraordinary privilege, the ability to print paper and exchange it for real goods. Dollars were created and oil flowed in. Dollars were created and factories overseas shipped products back. The system worked because the rest of the world trusted the paper more than the things. That trust is eroding. When China pays $75 for silver while New York trades at 70, it is not simply overpaying, it is making a statement. It is choosing to hold the metal rather than the paper claim. It is prioritizing possession over promise. And that choice is being made at scale. To understand why this matters, you have to understand how different cultures view wealth. In the West, wealth is typically represented by numbers on a screen, a brokerage account, a bond yield, a bank balance. These are financial claims. They are promises to pay. They function smoothly as long as the system behind them is stable. In the East, particularly among the BRICS nations, wealth is increasingly viewed as tangible. Resources, energy, food, metals, things that exist outside the financial system, things you can hold. The lesson they have absorbed is simple. In a crisis, financial claims can be frozen, sanctioned, restructured, or defaulted on. Physical assets cannot be erased with a keystroke. This is why China is quietly moving toward a resource-anchored framework. It is not officially declaring a gold or silver standard, but it is shadow-backing its system by accumulating strategic commodities at scale. Silver is central to that strategy because it sits at the intersection of industry, energy, and monetary history. When silver trades at a premium in Shanghai, the market is signaling a preference. It is saying that the physical asset is more trustworthy than the derivative built on top of it. This is not a temporary opinion. It is a vote of no confidence in Western pricing mechanisms. For over a century, London set the benchmark price for silver. A small group of institutions determined what the metal was worth, and the decimal world accepted it. But that system only works if the price setter controls supply. London no longer does. If you quote a price at $70 but cannot deliver metal at that price, the number becomes theoretical, a paper price. Shanghai, by contrast, has the metal, the factories, the refineries, and the demand. Miners in Peru and Mexico are beginning to recognize this reality. They are asking a simple question. Why sell based on a Western benchmark when the Eastern market pays more? This is the de-Westernization of pricing power in real time. The center of gravity is shifting east because the balance of positioning is shifting. The East is structurally long physical metal. The West is structurally short paper claims. That imbalance guarantees higher prices. The owner of a scarce asset always dictates terms to the borrower. This brings us back to the banks in New York. Their traditional strategy has always been straightforward. When prices rise too fast, flood the market with paper contracts. Create artificial supply, push the price down, shake out weak hands, regain control. In a unified market, that strategy worked. In a bifurcated market, it backfires. If banks smash the paper price to 65 while Shanghai holds at 75, the arbitrage spread explodes. That does not scare buyers away. It invites them in. Every ounce becomes even more profitable to remove from Western vaults. The banks effectively subsidize the export of strategic wealth. They accelerate their own inventory loss. This is the trap. If they suppress the price, they lose the metal. If they allow the price to rise, they lose on their derivative positions. There is no winning move. That is why the behavior of silver has changed. Price no longer collapses and stays down. Every dip is met with immediate demand. The Shanghai bid acts like a put option under the market. Whenever New York weakens, Shanghai absorbs the supply. This is the ultimate floor. As the BRICS nations increase trade in local currencies, another pressure builds. Dollar demand declines. Excess dollars flow back into the United States. This fuels domestic inflation. Inflation is not only created by printing money, it is created when a currency loses its ability to purchase real goods abroad. Silver is the canary in this process. It is rising because the petrodollar system is fracturing. Energy, resources, and industrial inputs are being repriced in real terms, not just in dollars. When you hold silver, you are hedging against the loss of monetary privilege. You are choosing value over fiat. So where does this all resolve? We return to the numbers. New York is trading near 70. Shanghai is trading near 75. Two prices for the same asset cannot coexist indefinitely. The laws of economics are unforgiving. One must move to meet the other. Because Shanghai controls the physical flow, New York must rise. That makes 75 not a speculative target, but a gravitational one. It is not about excitement or hype. It is about equalization. The market is not guessing where silver should go. It is being pulled there by structural forces. Traders understand this. They are buying the Western price and waiting for the spread to close. This buying pressure does not care about overbought indicators or technical resistance. It is mechanical. It is math resolving itself. The arbitrage is real. The currency war is real. The gap must close. That brings us to strategy. Many investors have been taught to dollar cost average. Buy a little each month. Smooth volatility. In sideways or declining markets, this approach works. In a vertical repricing, it becomes dangerous. Each purchase buys fewer ounces. Your average cost rises as price accelerates. The largest players do not dollar cost average during regime shifts. They front load. They recognize when a market transitions from accumulation to repricing. They allocate capital before the spread closes, not after. Waiting for a pullback that may never come is how opportunity is missed. The Shanghai floor implies that any dip below 70 will attract immediate buying. Arbitrage bots do not hesitate. They execute. That means volatility, but it also means support. The next question is always the same. When do you sell? But sell for what? For a currency that is being debased? The wealthy do not think in terms of selling for cash. They think in terms of swapping value. They exchange one undervalued asset for another. The most powerful tool for this is the gold to silver ratio. At present levels, it takes roughly 43 ounces of silver to purchase 1 ounce of gold. Historically, that ratio compresses during precious metals bull markets. In 1980, it reached 17 to 1. In 2011, it touched 30 to 1. Geologically, silver emerges from the ground at roughly 8 to 1. This gives you a roadmap. When the ratio is above 40, silver is cheap relative to gold. You hold silver. When the ratio approaches 30, you consider swapping some silver for gold, locking in purchasing power. When the ratio approaches 15, history suggests a full swap. You convert silver into gold and dramatically increase your metal base without ever touching fiat currency. This is how long-term wealth is built, not by chasing paper profits, but by accumulating ounces and exchanging them intelligently. Is $70 a bubble? The media will claim it is. They always do. But look at the inflation-adjusted numbers. In 1980, silver reached $50. Adjusted for inflation, that price exceeds $170 today. At 70, silver is nowhere near its real historical high. Now consider fundamentals. In 1980, solar did not consume a fifth of global supply. There were no billions of smartphones, no electric vehicle revolution, no export bans, no industrial hoarding. Today's fundamentals are exponentially stronger, yet the price remains lower in real terms. This is not a bubble. It is a repricing. Silver is not a collectible. It is a strategic energy metal. It must be priced high enough to ration demand. 70 is not the ceiling, it is the launch pad. The facts are simple. New York trades near 70. Shanghai trades near 75. The arbitrage gap drains Western vaults. The only way to stop the drain is for New York to rise. The path of least resistance is higher. The banks are trapped. The East holds the metal. The captain has changed. Ignore short-term volatility. Ignore commentary that does not understand arbitrage. Watch the spread. As long as Shanghai remains higher, the vacuum remains active. The East is buying. Industry is buying. If you understand the mechanics, you do not panic. You hold. The gap is real. The repricing is real. Now watch it close.